Superannuation is simply just a tax-effective investment structure. The amount of super statements you'd get from random people who had never changed their address around tax time just made me realise how little understanding there is of superannuation, and people aren't even taking it seriously enough to change their address. Most super funds these days have a range of investment options for clients to choose. So they should always consider, firstly, their investment timeframe, but also look at the costs of each investment option, the past performance, and then make an informed decision around whether they should make that switch.
If someone's not really engaged with their super before, what's the first tip that you'd tell them to do?
Probably first step would be to...
Michael, thank you so much for joining us on LevelUp, and so excited to have you today talking all things superannuation.
Thank you. Thanks for having me.
Yes. Can you start with the basics about what is superannuation and why is it such a powerful tool for retirement?
Sure. So superannuation is simply just a tax-effective investment structure. So you can own most of the same investments that you can in your personal name within super, particularly if you have a self-managed super fund.
Right.
So really what it is just a tax structure. Now, the one downside is that you can't access your money typically until age 60 for most people.
Yep.
But for that downside, you get a lot of pros. And one of the main pros is that it's a really tax-effective investment structure. So the earnings that it generates are taxed at 15%.
Right.
And when you compare that to many people's marginal tax rate, which could be as high as 47% on the earnings that they make,
that's huge.
You can save a significant amount of tax, often up to 32%.
Yep.
Now, in addition, when you make contributions, most of them are also received at 15%. Some of them are 0, some of them 30, depending, again, on your tax rate and the type of contribution.
Sure.
But if you compare that, again, to people's marginal tax rate, you can save a significant amount of tax on the contributions versus taking the money as income as well.
Sure, perfect. Thank you for sharing that. I think we will specifically touch on the contributions part separately and we'll delve a bit more deeper into this. But thank you for sharing that. But I also wanted to understand, why do you think that most Australians do not pay much attention to super until later in their life? Like, why do you think most Australians do not pay attention to super until later in their life?
Yeah, it's probably due to a lack of understanding around what superannuation is. Because a lot of people say to us, my superannuation doesn't perform well.
Yeah.
And they think that it's super as a whole, but actually what it is the underlying fund that they're in isn't performing as well as, say, their expectations or perhaps their own personal investments. So it's actually a problem with the underlying fund or the underlying investment options within that fund. It's not a problem with actual superannuation as a whole, because again, super is just a tax-effective investment vehicle. So you can always get a better super fund, and you can find that, or you could have your own self-managed super fund if that appeals to you. But really, there's just a lack of understanding with superannuation because we're not taught this at school.
Yes.
You have to find out for it yourself or go and see a financial planner.
Exactly. And I actually come across people who probably they don't know where their super is. And if I ask them, can you maybe show me a super statement, or can you tell me which fund are you with or something, because I probably may need some details for the insurance part.
Okay.
They're like, no, I have no idea. I'll probably have to check with my HR, or I'll have to dig deeper. I was like, this is surprising. Like, people do not look at, they don't even know. Like, it's appalling to know these statistics. So
it's really eye-opening. When I used to live in a rental house, in your 20s before you buy your own house, the amount of super statements you'd get from random people who had never changed their address around tax time just made me realize how little understanding there is of superannuation, and people aren't even taking it seriously enough to change their address.
Exactly.
They're not going to know, what the tax rates are, how it performs, what contributions they can make if they don't know the basics like that.
100%. And this is such a basic thing, like getting your address updated is as basic as it gets.
Yeah.
Because I actually came across a client who actually didn't even have their name recorded correctly on the super fund. Like, sometimes they join their work in their early 20s and they just give something and the name may not have been like sometimes people have longer names and the first name, last name don't align the way they need it on the passport versus their superannuation. And unfortunately, that client had a claim and she couldn't claim because the name didn't match. I was like, this was the least you could get right
Yeah.
at the start.
Yeah, that's right. It's yeah, and a lot of people, they start their first job, particularly working in, say, retail. So they might, be with a fund like Rest, for
Yes.
instance,
Yes.
and they've set it up all those years ago. It may have the wrong name. Sometimes
Yeah.
they've never actually signed anything, so you can't get a third party authority actually approved because they've got no signature on file. So things like that. It's just it's really difficult for a lot of people to understand how things work in super.
Yes, absolutely. But when we were talking about the contributions, can we delve a little bit deeper into that? And what are the different ways people can boost up their super savings and different ways they can contribute to it?
Sure.
I think the obvious one is the super guarantee, which the employer
Yeah.
contributes.
Yep.
And if you can maybe guide
Yeah,
us
sure.
further on that.
Yep. So the super guarantee for employees is currently 11.5%. So 11.5% times your base salary is what your employer should be contributing each year.
Sure.
You can also make a range of additional voluntary contributions. So there's, for instance, pre-tax concessional contributions, which are often really effective for people on the higher tax rates.
Sure.
And then there's also non-concessional post-tax contributions, which are often more effective for people perhaps on lower tax rates. And there's also a range of other ones, so downsizer contributions and many more, spouse contributions. There's definitely a range.
Sure.
What I see most people use are the concessional contributions because, again, the money is often going into the super account at 15% instead of their marginal tax rate, which could be as high as 47%. So they're saving 32 cents in the dollar by making those contributions.
So if I just simplify concessional versus non-concessional, concessional is what is taxed at the marginal tax rate, and the non-concessional may not be taxed at 15%. Is that a simplified way of saying that?
So a concessional contribution, it gets taxed at 15% when received by the super fund. However, it comes off your income tax. So, for instance, if you there's a couple of different types of concessional contributions. You can either salary sacrifice, which is where your employer does it each pay cycle.
Sure.
Or you can actually do a personal deductible contribution, which means you could put a lump sum, let's say, $20,000, and then claim the tax deduction with the super fund, and that would come off your taxable income,
Sure.
Which could save you, again, as much as 47%. Whereas with non-concessional contributions, they're received tax-free by the super fund.
Right.
However, you can't claim a tax deduction for your personal name. So that's why you typically only do that if you're in one of the really low income tax rates, because you aren't benefiting from the tax deduction in your personal name.
Get it. I'll probably talk more on the concessional side, which is salary sacrifice, one of the more common ways that people contribute into their super.
Yep.
Again, I'm just going to talk numbers. If someone's earning 120,000 income here, and so at 11.5%, the employer's probably contributing close to 13,000 into the super anyway. Is there a maximum limit as to how much that person can contribute to stay in the concessional rate and at probably tax at the marginal rate at 15%?
Yeah. So there's a yearly cap of $30,000. So in that example, that person could put an additional roughly $17,000 a year to be under their yearly concessional cap.
Sure.
There is something called carry forward contributions, which if your balance is below 500,000, you can actually use any unused contribution cap space from the previous 5 financial years.
Wow.
Yeah, which can be really effective if, say, you're a high income earner, or perhaps you've triggered a significant capital gain in that year, for instance, selling an investment property or something like that. Many people utilize those contributions all at once.
So they could go all the way up to 5 years back in time and then calculate what more they could contribute.
Yeah, absolutely. So often people have, 50 to 100,000. If say they're someone who's new to the country, sometimes the carry forward cap space can be as high as sort of 130,000, and they can put that all in one hit, which can be a really good way for, say, people that are new to the country to catch up and start building their super.
Sure, that's very interesting to know. And yeah, and regardless if they didn't want to carry forward as well, they've got up to 30,000 they can utilize and reduce their personal taxable
Yep.
income by that much and save on tax eventually.
Yeah, absolutely.
Perfect. Thank you. And coming on to the voluntary contribution as well. So if they're not salary sacrificing and maybe come to June, they realize that they have potentially a huge tax bill at the end of the year, can they decide to contribute at that time and reduce their taxable income?
Yeah, you can. So that's called a personal deductible contribution. So you can put in, subject to the caps that we talked about earlier, a certain amount, and then you submit a form to your super fund to claim that tax deduction, and then you'll be sent an acknowledgement letter back.
Sure.
And then that then can come off your income tax.
Okay. Is there a general rule or a percentage that you would recommend your clients to make as contributions into your super, or is there any basic formula that anyone could use or refer to?
Not really, because you sort of need to work out what is the family's surplus cash flow as a whole. And then from there, work out what portion do you want to put into superannuation. You may want to put some portion into additional mortgage repayments, another portion into personal investments, perhaps. So it's hard to give a sort of rule of thumb percentage, but always the more the better for the obvious reasons of how much you can potentially save in tax by contributing to super.
Sure. So it's definitely a great tax saving strategy. And I think once just for the listeners, I think once they've kind of worked out what their goals are and how much they can contribute into the different requirements and liabilities they may have, and whatever's being saved, they could use a part of that or a big part of that to put towards their super and save on tax eventually.
Yeah, absolutely.
Perfect. And do you want to give some insights as to what even smaller contributions into super make over time?
Yep. Well, compounding returns has once been described as the eighth wonder of the world. I've heard, I think maybe that was Warren Buffett. So obviously doing that in superannuation is even more effective because the tax rate is only 15%. So the more you put in, the more it's going to compound with those investment returns. And we often show clients a real significant benefit between, say, doing nothing and just receiving their standard employers' contributions versus, if they start making even a modest, salary sacrifice, perhaps, 5%, 10% of their wage, it can often be hundreds and hundreds of thousands at retirement.
Wow, that's huge.
Yeah.
Great. I wanted to also now talk more about the investment strategy in super. I think most super funds allow you to invest in, I think, 3 broad strategies: conservative, balanced, or growth.
Yep.
How should someone decide which is the right strategy for them?
Yeah. So with any investing, it's all about working out what your time frame is. So a lot of my clients who are either in retirement phase or about to retire will start to want to have a more conservative investment profile. And that may be, say, 50% or 30% in shares and property and the rest in cash and fixed interest products.
Sure.
And the reason why they want to do this is property and shares are often the highest returning asset classes, but they also have more volatility.
Sure.
And for retirees and pre-retirees, they actually want to lock in the capital balance and start getting less volatility. So they may be happy to accept a lower rate of return each year, but they don't want the sort of, negative 30 or 40% if we have a really bad year. So then, because they've got a shorter time frame, if you contrast that to many of my clients with longer time frames, let's say they're 40 years old and they can't access their super till 60, then they might be happy to have, almost a full growth tolerance. So all in shares and property managed funds, because even if they do have a dip of, 20 or 30% because the market's gone down for whatever reason, they've got 20 years for it to rebound. And in fact, if anything, if they do receive a 30% dip in the market for whatever reason, it may be a good time to buy more.
Right. And they probably won't have the option like to buy more. You would just then invest more in that super fund so that they'll be able to contribute more and invest more through that strategy.
Yeah. So potentially make some additional contributions at that time in the market. I know for many clients, for instance, in the COVID dip when markets went down sort of 30% for only about 3 months or so, we were having conversations around let's obviously hold first. We don't want to lock in any losses, but why don't we make an extra contribution there? And those funds that, say a client may have put in $10,000 or $20,000, they've now received a 30-40% return on that money since then. So it's just about the mindset of looking at market dips as an opportunity if you've got a long enough time frame. And if you don't have a long enough time frame, then that's really when you should be invested in a more conservative investment style.
Sure. And maybe like the balanced would be for someone who's like somewhere in the middle, like they're not in their 40s, not in their 60s or...
Yeah, spot on. So balance depending on the super fund, and it's a little bit annoying because they all have different asset allocation percentages for the different names, but a balance is either usually 50% or 70% in shares and property managed funds, and the remainder in those cash and fixed interest. So that may be, for someone maybe early 50s with a lower investment time frame than the 40-year-old we spoke about before, but a longer investment time frame than, say, a retiree or someone about to retire in the next 12 to 24 months.
Absolutely. And if someone's with an industry super fund, do they have the ability to change that based on what their preferences are, whether they would like to be invested in a majority share-based portfolio or versus something that's more conservative? Can they do that?
Yeah. Most super funds these days have a range of investment options for clients to choose. So they should always consider, firstly, their investment time frame, but also look at the costs of each investment option, the past performance, and then make an informed decision around whether they should make that switch. Another couple of points to consider as well is if that fund does pay capital gains tax. And if it does, that may factor into your decision as to whether to keep switching. And also with industry funds specifically, often by switching investment options, you may lose access to what's called a retirement bonus, which you would otherwise get by not switching. So there's a few things to consider, but investment time frame is the most important thing.
Sure. And with these different things that you mentioned about the capital gains tax and the retirement bonus, can they figure it out themselves? Can a client call a super fund and find out, or is it best to speak to a financial advisor like yourself or someone they may know?
Yeah, it's definitely best to speak with an advisor about that because it would be a little bit complicated. But there's nothing stopping you calling up your super fund and asking for an unrealized capital gains tax report. Now, if they don't know what that is or they don't have one, it means that they're a type of super fund, most likely, where the capital gains tax is built into the unit price of the investment, which is a long way of just saying that basically all the capital gains tax is split amongst all investors equally rather than being on an individual account level.
Sure.
And those type of funds are often the ones that also then offer the retirement bonus. So if you ask your super fund for either an unrealized capital gains tax report or to know the retirement bonus value, then they'll either provide one of those or they should.
Okay. Right. And retirement bonus is a fixed amount, or it's probably a percentage of what your in balances?
Yeah, it's a percentage often. It's a really opaque system at the moment. So there's different formulas for each industry fund, but essentially because they're averaging out everyone's capital gains tax information, it's essentially a refund of the capital gains tax that they've put away for you if you end up not using it. And why you would end up not using it is because your fund then gets switched to pension phase, or you haven't made a transaction by switching investments. So you can call your super fund to find out what that potential balance is if they're that type of
If they
fund.
have it, okay. Any tips or insights on what super fund is ideal for a certain type of client or a certain age group, or especially on the industry super fund side?
Yeah, it's very broad. Industry funds usually do a really good job, especially for lower balances, because their fees are quite low. The performance is pretty good, but really, I have clients in industry funds, retail funds, and self-managed super funds. It all depends on the individual circumstances of the clients.
Sure.
So one of the main factors is their account balance. So often for self-managed super funds, you don't really want to go into one unless you have, at least 300,000, often a lot more, because you're still going to be paying the same flat accounting fees and audit fees typically, which is usually around about $4,000 combined. So if you have $1 million balance, it's obviously 0.4%. But if you have $100,000, then it's 4%. So
Sure.
Balance is one factor, but then also what type of investments do you want to have? So if you want direct property, for instance, you would need to set up a self-managed super fund. However, there's a lot of flags and risks with those. However, if you're just happy to let someone else manage it for you, then a retail or industry fund is fine. So really, we just want to look at the costs, the performance, what type of investment options and control do you want before working out which super fund to go with. But if you want to look at it generally, there is a super comparison tool available via the ATO. It mainly compares the My Super options, which are the default options of each industry and retail super fund. That can give you a little bit of a look at how well your fund's performing. And of course, if you need extra help, then financial advisors have all the software to compare that all for you.
Okay, perfect. Great. I will drop in the link to the ATO tool that you mentioned. So at least if someone wants to access it, they can. And of course, we'll have your details if somebody may want to contact you directly as well. With the retail funds, is there a specific balance range that you would recommend for someone to switch from an industry to a retail super fund?
Yeah, look, there's no magic number in terms of when a retail fund may be better than an industry fund, I guess, where most people start. In fact, industry funds can be great as well, long term, for people to hold all the way through. So really, it's just about doing the analysis around the cost comparison between each super fund, the long-term performance, what investment options they offer, and whether they fit you. Those are the main three things we consider, rather than looking at it on a case-by-case basis of whether it's an industry fund or retail fund.
Sure. And in order to do that, I think a person would have to go through a financial advisor, or can they set up a retail fund themselves as well?
I believe it's possible to set up a retail fund yourself. It's a good question. I haven't actually ever had that with a client, because I've always been the one to set it up if we are.
But the purpose would be to have bigger control on how the funds are invested. Would that be a reason for someone to switch?
Yeah. So a retail fund typically has way more different investment options. You could even invest in direct shares in your super with many retail super funds. It also has differences, for instance, around the way it calculates capital gains tax, and obviously differences in cost as well. Typically, retail funds have a higher minimum flat admin fee, and industry funds are more percentage-based fees. And that's sort of why industry funds are often better for people with lower balances, sort of circa 100,000.
Sure. Okay. But wanted to touch on the topic of insurance and super. I think a lot of the times most people get set up with insurance and super when they start with. And a lot of times people don't realize that they have something there as well. So do you want to maybe give us some more information about what there may be, and why is it important to look at it, and should they look outside as well?
Sure. So most super funds will give you a default level of insurance, and this default level is often very low, because they haven't asked you whether you want insurance. They haven't assessed your needs, whether you have debt or dependents or anything like that. So they just give people a really base level amount.
Sure.
And most people need a lot more insurance than that. And that's where, going through an insurance advisor like yourself is really important, to be able to top up the actual amount of cover that you need. Now, because it's default insurance within a super fund as well, and they haven't assessed people's health, it's often also a lot more expensive on a like-for-like basis compared to retail insurance cover, where you do go through some health questions, but it means that the policy is then often cheaper on a like-for-like basis than default insurance. So for anyone, I always recommend they speak to an insurance advisor like yourself to be able to work out how much cover each client needs based on their individual circumstances, and then pick the best insurer through a retail insurer based on the cost, the quality, and also if people have had past health conditions, then obviously an insurance advisor can then work out which of the insurers may be the most favorable for that particular condition.
Sure. And it's so surprising that you say that it potentially could be cheaper to switch it, because the biggest misconception people have is that it is going to be the cheapest in my super fund. If I go outside, it's going to cost me more. And without even looking into it, without even looking at the options, it's just something that they believe in. So
exactly. For that exact reason we spoke about, if everyone is in a default insurance scheme, then you've got a large portion of clients that may be unhealthy, for instance, that are triggering more claims. Whereas with retail insurance, everyone's being individually medically assessed. So it may mean in certain circumstances, a client may not be able to get cover, or it may have loadings or exclusions with a retail provider. However, it means if you're fit and healthy, your retail insurance is typically much cheaper on a like-for-like basis.
Sure. Thank you for that. Have you, in your experience, ever come across someone who may have relied solely on their insurance in their super fund and then fell short of it?
Yeah, absolutely. Because whilst most super funds do offer default insurance, there's a couple of caveats. Many don't offer income protection, as an example. It may only be a small amount of life and TPD.
Sure.
And they also don't offer trauma insurance, which is the one type of insurance that you need to pay for personally. So there's a lot of gaps there if you're solely relying on your insurance within super. And then the next thing is many people's insurances got cancelled on them a number of years ago as a result of some unintended super reforms. So there's actually many people who may not even realise that they no longer have insurance within their super.
Okay. That just probably brings that important thing again, that it's so important to look into your super and just make sure what it is, what fees are you paying, what insurance you have, how you invested, and everything coming back and reviewing. It's just another bank statement, because people look at the bank statement so much more versus their super fund. But I think something that they should wake up and start looking into.
Absolutely. We were talking about how many people we've seen in the past not even update their address on their super fund. Can you imagine the amount of people that also then get the fund and put it straight in the bin, even if they have the right address? So really there's the main things people should be looking at with their super statement is the investment options and the performance of the fund, whether they have insurances, whether they have beneficiary nominations, and also the costs of the super fund as well.
Sure. And I think the beneficiary nomination is something that you need to contact the super fund and get it done. Or is that the process to do it? Because a lot of people wouldn't have it.
So you don't get one by default. You have to contact your super fund to get a beneficiary nomination form. And from there, you can then nominate an appropriate beneficiary, which isn't everyone. They have to be a tax dependent, a super tax dependent, to actually be a beneficiary. So many people who say have no dependents may try and nominate their sibling, but that's not considered a dependent for super.
So it could either be their children or their partner.
So in that example, if they wanted to nominate their sister, they would have to create a will through an estate planning lawyer which nominates their sister, and then in their beneficiary nomination for super, nominate the will. They can't directly nominate their sister.
Right. Okay. Interesting. Again, this is something that's new to me as well. And I'm sure most people wouldn't know. So it's easiest to, if you have dependents like children or partner, it's easiest to nominate them as a beneficiary versus other people, unless you have a will and then you do that.
As a rule of thumb, most people would nominate their spouse first, which is the sort of most effective for a number of reasons, including tax is the big one there. But if they don't have a spouse, or they don't have a spouse anymore, then it's always good to review your wider estate planning with a professional.
Sure, perfect. A very basic question. At what age should someone start getting serious about their superannuation and retirement planning?
Yeah.
Do they need to wait until their 50s?
No. Well, ideally, the earlier the better. Obviously, for the reason we were talking around compounding returns.
Yeah.
The earlier you start focusing on building your super and your retirement planning, the better you'll be off. Obviously, it's easier said than done, especially for people in their 30s and 40s, when they've got large mortgages. They might have private school fees, all these sorts of expenses that are really significant. But even if you can put away a small bit extra into your super, that will have really great compounding benefits in the future.
Sure.
But in terms of the absolute maximum when you should start looking at it, especially after you finish paying off your home loan, that's when a lot of people then just focus everything on super. Yeah.
Okay. When we talk about retirement, what options are available when it comes to accessing your super in retirement? Is it always a lump sum? Is it an income stream? Or is it account-based pension? Can you just maybe briefly touch on all three of them and explain it a little bit more?
Sure. So there's a couple of different types of pensions you can set up. You can set up a transition to retirement pension from age 60, which limits you to only taking 10% of the account balance each year.
Okay.
But you can do it whilst you're still working, which is often beneficial for people who need a little bit extra cash flow, or even to do a strategy where you also contribute at the same time to be able to save tax, because those withdrawals that you receive are received to your bank account tax-free. So then if you put more money into your super, you can then save on income tax.
That's right.
Then from either age 65, whether you're working or not, or from age 60 and retired, whichever comes earlier, you can set up a full account-based pension. And the benefit of this type of pension over the transition to retirement pension is that it's now fully tax-free. So all the earnings are tax-free rather than being taxed at 15%.
Sure.
And you can take out as much as you want. So there's no longer that restriction of 10% of the account balance each year.
Sure.
In terms of whether to take a lump sum or a monthly pension, most of my retiree clients prefer a monthly pension because it sort of replaces their salary in a way when you eventually retire.
Yep.
But particularly with the account-based pension, you have the full flexibility of taking out more as you need it. One important thing for people to do that's often overlooked is, especially if you're eligible for a full account-based pension, you should always convert your accumulation account to that, because even in retirement, let's say you're 75, if you leave it all in an accumulation account, maybe because you don't need any money or any income stream, you're still getting taxed at 15% on all the earnings. Whereas if you switch it to that full account-based pension, all the earnings are tax-free. So sometimes I see clients who just haven't realized that, and they've been paying thousands of dollars extra earnings tax each year just by not switching.
Okay, great. Thanks for sharing. That's a very valuable tip.
Thank you.
If someone's not really engaged with their super before, what's the first tip that you'd tell them to do?
Sure. Probably first step would be to actually find all their super funds if they're not that engaged, which we see that commonly, people not knowing where their super funds all are. So you can log on to MyGov in the ATO portal, and that'll link all your super funds that are linked against your tax file number.
Sure.
So firstly, you can find all of those. Then if you're looking to consolidate, be mindful of the insurances, of course. So it could be a good time to see you, Priyanka, to actually then review the insurance as a whole, because you're probably going to be consolidating into one super fund for costs. So that way they can set up their insurances and be safe, even if it's with an external policy. If they're reviewing their super fund on a like-for-like basis, again, they can look at that super comparison tool available via the ATO. And then lastly, also looking at what additional contributions to make, if any.
Sure. And I have seen that a lot of people do have multiple super funds, which they may or may not have realized.
Yeah.
But it's ideal to have it all under one, right? Because what's the pros and cons of having multiple super funds?
Yeah, so the main one would be duplicate fees. So typically each super fund will have a flat admin fee.
Sure.
So if you've got multiple, then you're paying all of that.
All.
Yeah. Whereas by combining, you can skip some of that.
Right.
And also makes it obviously a little bit easier to manage as well, not having as many funds. And you can really focus in on which is the best fund for me based on cost, performance,
Sure.
and all those other factors.
Perfect. Thank you for that. How can people make sure that they do not outlive their super or they do not run out of their super funds too early?
Yeah, sure. So whenever we're sitting down with a pre-retiree client, we first map out all of their life goals. So when they want to retire, how much they want to spend in retirement each year. Sometimes they might want to travel more or help out their kids with a gift of some sort. So once we hear that, we then use our financial modeling software to work out, are they actually on track, or would those goals then lead them to run out of money too early? Then if it would lead them to running out of money too early, we then put in some of our strategies. So it could be things around super contributions or changing their investment mix, maybe spending a little bit less, whatever it is, to see, can we push out that time frame and the amount of years that their funds last. And in many cases that works a treat. If that's still not possible, even with all our best strategies, then we can start talking about the different trade-offs of things. So it could be questions around, would you prefer to work 2 years later? So instead of 60, work till 62.
Right.
But our modelling shows that you can then spend $15,000 a year in travel per year after that in retirement.
Right.
And then people can have the information to go, oh, actually, that's a fair trade. I'll just work a couple of years later so I can travel each year in retirement.
Sure, that's amazing. And it shows the value of making informed decisions. Like people could just assume that I'm going to work until 60 and I'll be okay until the rest of my life. But shows the importance of having an expert like yourself come in and actually do a proper plan and a model which shows them what an extra 2 years could mean to them in their retirement.
Yeah.
So thank you for sharing that.
Yeah, no worries. Yeah, it's interesting because a lot of times people will say, oh, retirement age it's 65, isn't it? And you say, oh, well, there's actually no technical retirement age. What there is there's the ages you can access super, which is first at 60 or 65, depending on the situation. Then there's the age at which you could be eligible for government age pension, which is 67.
Sure.
But there's nothing stopping you retiring at 55, provided you've built up enough surplus personal investments to fund your retirement until your superannuation can kick in. So that's where all that modelling and forecasting comes in to show people, are they on track for what they want to do.
Sure. No, that's wonderful. And I think, thank you so much for sharing those insights. I'm sure all the listeners would gain so much value and information out of it to make informed decisions. And regardless if they wish to speak to you, I will have all your details in the description. So
thank you.
Thank you so much for that, Michael.
Thanks,
Really appreciate it.
Appreciate it. Thanks.
Thank you.